Good morning, Business 101 students, and welcome to week 5. So this week we will be looking at a couple different chapters, chapter 9 and chapter 10. So we are rounding the corner in week 5 of 8. And so when we are looking at chapter 9, and I also have a few videos for you this week, there's not a discussion post this week, homework 9 and 10. If you have not finished 7 and 8, the entrepreneurship chapter and the accounting chapter, be working on those to get those handed in. We are in week 5. Again, just a reminder, this course is a survey course, so each chapter really is a whole area of business study. And by taking Business 101 early on in your career here at EC3, or in your career in school or in general, it kind of gives you an idea, the overview or survey of all of the different areas that you might be interested in, specializing in, or different areas that relate to business and are areas of study. So those are some of the fun facts about Business 101. So moving on to chapter 9. Chapter 9 talks about, once you read the chapter and go through the short PowerPoint, it talks about maximizing value and this idea of acquiring funds and how to use those funds. Basically, get the most for your dollar. Businesses want to be efficient and they want to be effective with the usage of their money. And so how do they raise money? And then how do they apply or allocate the funds that they raise? And so one of the things that we talk about in this chapter, and it relates also to the stock market, but in life in general, this idea of a risk-return trade-off. And that we invest in things, when we invest in things that are more risky, we take a calculated look at, what will be, if I invest in a certain area, what will be my return? So I might be, you always get bigger returns if you invest in an area that pays off. Just like if we're thinking about risk return is very much so, any of you that have ever been to or heard about something like the Kentucky Derby, a horse race. When the odds are 50 to 1 that a horse will place, so there's a very unlikely chance that a horse will place, you win really big. If you bet $1, you might win $50 for the dollar that you bet. However, if there is a horse that is picked to win, then it's highly likely that that horse will win. So if you bet on that horse, you might only win, $3 for every $2 that you bet versus $50 for every dollar that you bet. The likelihood, though, that the horse that pays big wins is very low. And so but the payoff is very large. And so that idea of horse racing and how they kind of gauge that, horses, which one might win, is very much representative of the risk-return trade-off idea. And so then this chapter, in chapter 9, we also start to talk about a few, and there's a short video that talks about these different ratios as well. Thinking about ratios let us compare things and kind of do a snapshot of a business so that we can compare it against other businesses or maybe how it stacks up in the industry. And for instance, there is something called a liquidity ratio that we can look at a business and we can say, okay, let's measure the ability of a firm to obtain cash it needs to pay its short-term debt. Meaning, how quickly, so firms that were fairly liquid and their liquidity ratios were good, they were able to quickly turn around money at the beginning of COVID and still make payments on the different things they needed to do to take care of. And so we want to see a firm is healthy when it is able to generate cash very quickly. So the ability of a firm to obtain the cash it needs to pay its short-term debt, that's a liquidity ratio. And a liquid asset is something, or an asset that you can turn, liquidity ratio represents those assets that you can turn into cash. So a liquid asset is just that, an asset that can quickly be converted to cash with little risk of loss. So something that would be not a very liquid asset would be like if you owned land or if you owned a building and you had to try to sell it, because it's a market value as to what that would be, the land or the building. It's also a market value, or it's a market that tells you how long it might take you to sell it. You can't just immediately sell it. there has to be a specific buyer, especially the more specific the piece of land and the price point of the land. You're going to have or of the building, a very specific buyer that you need to actually find to sell it, to make the money that you may or may not make the money that you think you're going to make. So building and land would be fairly low liquidity. A few other ratios: asset management ratio measures the effectivity of a firm in using its assets to generate revenue. So if we see that a firm has an asset management ratio that's healthy, that means that it's using its assets in the assets it has. It's basically applying itself well, versus a firm that possibly has a lot of assets but isn't really generating revenue from those assets. So what does that tell us about a firm or about a company? If you have two companies and they both have similar assets on the books that they're working with, to, like land, building, human resources, intangibles, all of the different assets that they might have. And you have two companies that have the same basic amount of assets, and one is generating a bunch of revenue from those assets. The other is not generating, it's generating a small amount of revenue. And so what we see is that the firm that is able to use its assets effectively can generate revenue. So the firm that maybe has a small amount of revenue means that it doesn't really know what it's doing. It's not applying itself. And so the asset management ratio, when we look at that, firms that have a healthy ratio versus an unhealthy ratio, that tells us a little bit about the operations happening within that firm. Leverage ratios, same thing, measures the extent to which a firm relies on debt. And so if you think about a firm that maybe owes a lot of money all over and doesn't actually have much capital or much equity in the business, versus a firm that does not have a lot of debt. And so why is that important? Well, it's specific to industries, but a firm that has a lot of debt, that makes it somewhat weak, right? It makes it that it has a lot that it's paying out and doesn't have much equity in the actual business, versus a firm that has a lot of equity. It's like if you own your car versus you just bought your car and you put no money down. If something were to happen, you don't really have much real ownership in a car that you have no money into yet, versus a car that you own. If you got into some sort of financial trouble, you could sell that car and actually make money, versus the other car you don't have any equity in, so that it's heavily leveraged or heavily relying on debt. So leverage ratio is another important ratio. Also looking at things like commercial paper. This is for large corporations, short-term promissory notes, revolving credit. That's any type of credit that a business might have with a bank that they can look at and pull from, whether it's for payroll or for inventory management. Maybe they get a large supply of inventory and do not put it directly on the books. They might use some sort of revolving credit from a bank. The other thing, when we look at long-term loans that banks might have, typically when there's long-term debt involved, the company that is giving the debt, or the loan company, and of whatever the reason is, they will have things written into these long-term loans that say, or long-term notes that say, okay, if you are planning on getting any other type of financing or doing other things financially, because we are tied to your business for a very long time, we would like to know about those things. Those are called covenants. Those are restrictions. Or maybe you can't get another type of long-term loan without consulting with us. We are the first loan holder on a long-term piece of debt financing. And so a covenant is things written into the loan that say, these are the rules that if we're going to give you this long-term giant loan, these are the rules that we would like you to play by. And so you kind of sign off on those rules. Those are covenants. Okay. And so when we're thinking about, this chapter also touches back on accounting and some of the things relating to the time value of money. That's chapter 9. And there are two short videos, financial ratio analysis, and then moving into chapter 10, and that starts to talk about, chapter 10 starts to talk to us about the markets and how the markets work. And so when we're thinking about the different markets and we're thinking about different types of investing, there are a few acts here that are of interest to you. in particular Sarbanes-Oxley in 2002 that really helped us, kind of drill down on some of the blatant inequities or the blatant holes that were in the existing laws up until about 2000 that allowed for companies to do things in an accounting way that kind of hid things. And so it made things more transparent and made the SEC, Securities and Exchange Commission, they were able to set some more rules and regulations for transparency. And so if you also look back, there is Securities Act of 1933, and that relates to a public offering or public, if you are having an IPO, the Securities and Exchange Commission, which is our federal office that is in charge of monitoring our publicly traded companies, which you have one of for your paper. You each picked a publicly traded company, and they're also the Banking Act of 1933. Again, think about the timing of these. 1933, that's right after we had the stock market crash and the onset of the Great Depression. And so in order to not have that happen again, the idea of the Federal Deposit Insurance Corporation, FDIC, so if you go into a bank, you go into PNC, and you deposit you can deposit up to $250,000 and it will be insured by the government. So if something happened and the markets fall apart or the bank goes under, the government will write you a check for up to $250,000 that you have in that bank. That did not exist during the Depression or during pre-Depression. And it did not exist in 1929 when the market crashed. And so if you had money in a bank, banks literally closed their doors and said, sorry, too bad, you lost the money that you gave to us. So there was no safety in banks. And so in order to restore that safety, the government instituted these some different acts that then took place. So thinking about Chapter 10, do a quick review of stocks. The other there are two videos here. How the stock market works is very interesting. A lot of you already know these things, but it'll be a quick brush up. And then Warren Buffett, How to Invest for Beginners, 3 Simple Rules. He talks a lot about Mr. Market in this video and the intelligent investor, Ben Graham. It's a wonderful, wonderful video. If you haven't heard of Warren Buffett, Google Warren Buffett. He is the Oracle of Omaha, he is behind Berkshire Hathaway, and he is one of the great investors and speakers. He speaks about investing of our time, older gentleman, written multiple books about investing and some of the tricks of the trade. So that is week 5. I will circle back with you. There's also homework for chapters 9 and 10, which is due next week. Have a great morning on this Monday morning, 11/11. Happy Veterans Day to all the veterans out there, families of veterans, and I will circle back later in the week. If you need something from me, I'm on campus tomorrow and Thursday for sure. Actually, Wednesday too, I think, at this week. The other thing is you can always reach out to me via email, crobertson@ec3pa.org, or shoot me a text, 814-490-6473, and we can connect that way. And make sure that you're keeping up with the homework, and you are keeping up with the different assignments, and you are researching your company. Again, Mary Howells in the library is also a great resource if you need help with your paper, need help with references, need help with your PowerPoint that you will be building that goes along with your paper.